If you're a contractor with a big mortgage or a HELOC, there's a good chance you're overpaying the IRS, legally and unnecessarily. Today, I'm breaking down the mortgage interest rules, the HELOC myth, and the strategy smart contractors use to turn bad interest into deductions. So let's get into it. So if you own a construction business, there's a good chance your house is doing more than just keeping a roof over your head. It might also be the biggest financial tool. But after the 2017 tax reform and now with the OBBBA, a lot of contractors are either overpaying taxes or leaving deductions on the table simply because they don't understand how mortgage interest rules actually work. So with recent tax law changes, let's talk about the mortgage interest deduction change. Before the tax reform, homeowners could deduct mortgage interest on up to $1 million of debt on their primary residence. After the tax reform, that limit dropped to $750,000. But here's the detail most people miss. The $750,000 cap only applies to new homes purchased after the tax reform. For example, a homeowner with a $1 million mortgage paying $40,000 in annual interest, with the old rules, they deduct the full $40,000. Under the new rules, they deduct 75% or only $30,000. And that missing $10,000 deduction adds up faster for contractors in higher tax brackets. So if you bought your primary residence before the tax reform, you're generally grandfathered in. But selling the home actually resets the clock, and that's why a lot of contractors lose this deduction. Now, refinancing itself doesn't reset your deduction limit as long as the balance does not increase. For example, if you refinance your $1 million mortgage down to $950,000, the new cap for you would be $950,000. Now, if you refinance and increase it to $1.2 million, only the original $1 million will qualify. That extra debt needs to be evaluated separately. Now let's talk about cash out refinances and equity pulls. If you pull cash out during a refinance, interest on funds used for personal purposes is not deductible. Interest on funds used for business or investment may still be deductible. And this is where contractors get tripped up and miss out on opportunities. And before we get into that, let's talk about HELOCs real quick. So a home equity line of credit interest on a primary residence is generally not deductible anymore if used personally. Before the tax reform, up to $100,000 of HELOC interest was deductible, but that rule is now gone. So HELOC interest can only be tax deductible if the funds are used to buy, build, or substantially improve the home securing the loan, and subject to the same $750,000 cap that we spoke of earlier and commingled with that other loan. So the $750,000 cap applies between all of your loans secured by your primary residence. So again, what happens when you run beyond that cap? And this is where proper tax planning comes in. But HELOCs are not useless. Again, there's another opportunity here. So let's talk about interest tracing and how you can take advantage of all these loan products to maximize your tax benefit. The IRS cares about how loan proceeds are used, not just where it's secured. And this is called interest tracing. For example, you pull $200,000 from a HELOC on your primary home and you use it to buy a rental property. In this case, the interest may be deductible. If you use it to buy a business entity, again, the interest would be deductible. But what you have to do to get the deduction is audit-proof your setup. So what you really should be doing is moving those funds into a separate bank account. Use that account only for investment or business and avoid commingling personal spending. In addition to a clean money trail, you should also have an interest allocation file. This might live in Excel, Google Sheets, or your accounting software. Although it might be hard to do this in your accounting software, I'd recommend Excel or Google Sheets. And you should have several columns here, and they should include date funds were drawn, the loan source, the HELOC, regular line of credit, a margin loan, the amount drawn, bank account deposited into, use of funds, that is rental, business, investment, personal, the entity or schedule tied to use, the percentage allocable to each use, and the interest paid monthly. And with this, you can allocate the interest allocable to each activity, personal, business, rental, investment, and cleanly, in a very clean way, between the separate bank account and this interest allocation file, claim the deduction of the interest on your business returns. And I know that might sound like a lot. This is something we do for a lot of our clients. This is a part of proper tax planning. So as always, our link is down in the show notes if you want to speak. A clean money trail would equate to a clean set of deductions. So let's talk about what changed and didn't change under the OBBBA that got passed here in July of 2025. Under the OBBBA, the $750,000 cap remains, grandfathering rules were preserved, interest tracing principles remain intact, and business and investment interest deductions were not eliminated. The OBBBA did not bring back unlimited home mortgage interest deductions. What it did do is increase scrutiny on how debt is structured and classified, making proper planning more important than ever. So what are the contractor takeaways from this episode? What I want you to leave with. Number one, not all mortgage interest is deductible anymore. Number 2, selling your home can permanently reduce your deductions. So proper planning around that is more important than ever now. I mean, if you need to sell, you need to sell, but you want to plan things properly to not miss out on the deduction. Number 3, refinancing is safe unless you pull out cash. Number 4, HELOC interest depends entirely on usage. And number 5, interest tracing is one of the most powerful tools contractors underuse. So if you have any questions on any of this or want help setting up properly, please feel free to book a time. We're happy to speak. Our link is down in the show notes, and see you in the next one.